Hello friends, in this video we are going to discuss the solution to a very important question in each and every investor's mind which keeps us awake and have sleepless nights: when to sell a stock. For those who are having a profitable position, they fear that they may lose the profits which they have made over the several years, and for those who are holding a position in losses, fear that their losses will drastically increase if they don't sell the stock. So by the end of this video, you'll have a clarity. All the long-term investors will have a clarity when they should ideally be selling a stock. My name is Varun Agarwal, and let's get started. So to create a long-term wealth in the stock markets, it is not just important to know which is the right stock to buy, when it is the right time to buy, but it is equally important to know when it is the right time to sell the stock. But when is this possible? This is possible only if you know in depth about which companies you have purchased and you are constantly monitoring your portfolio stocks and those companies on a regular basis. When you say monitoring, a lot of people think monitoring is just keeping a track of the prices of the stocks. It is not just about that. You should know about the latest developments in the company. What are the policy changes? What are the growth prospects? What is the change in the management of the company? So all these developments should be tracked, and that is called monitoring of the companies or the stocks. Every one of us is investing with an ambition or with a goal in our mind that once at least in our life we should have a 100 bagger stock. So you give this question a thought, that the 100 bagger stock was also one day a 2 bagger stock, a 5 bagger stock, or a 10 bagger stock. If the investor who is holding a 2 bagger stock sells that stock when it doubles, then he will never be able to get the opportunity or get the gains of a enjoy the gains of a 100 bagger return. So it has to be kept in our mind that when you are planning to create a long-term wealth in the stock market, patience is the most important trait as an investor we should have. Now, before we begin, let me discuss a few quotes of Mr. Warren Buffett, who is a great inspirer to every one of us. You cannot produce a baby in 1 month by getting 9 women pregnant. So by this, you can understand that just by investing in a lot of stocks, you can't think that you can make quick returns in all the stocks and make huge amount of money. When we own portions of outstanding businesses with outstanding managements, our favorite holding period is forever. Whenever I speak to the portfolio clients or friends or anybody, the moment we talk about a stock selection, the very next question they ask me is, till when should I hold this stock? It makes me a little furious, or I feel a little funny to answer them that you should be holding this forever. You should be holding this till the purpose for which you have bought this stock is still remaining. An investor should act as though he had a lifetime decision card and with just 20 punches on it. So imagine that in your stock market life or as an investor, also you have only a card with on which you can punch 20 times, or you have a portfolio and you have to take only 20 permanent investment decisions of your life, or you have to select only 20 good stocks in your life. So when you have such a thought process, automatically your investment thoughts or investment criteria or your decision making process completely changes. So this is one of the three most inspiring quotes which relate to the concept which we are discussing in today's video. What are the different common selling strategies which we see around us? A lot of people propagate that whenever a stock doubles, sell it. Never sell below your cost. That means once you invest in a stock, if the price falls below your investment price and you end up making a loss, you should wait until the lifetime, and wait at least till you reach the cost. A lot of people propagate that once a position turns profitable, you should not let it turn into a loss-making position. At least you should sell it off at your cost price. Another thinking is take your investment amount and leave the profit. This is the most common one. The moment you start earning profits, handsome profits, people try to take out their investment amount from that stock. Suppose they invest 1 lakh in a particular stock and the value becomes 1,50,000. They take out that 1 lakh and leave the 50,000 profit, irrespective of whatever happens with the company or the stock. Some people propagate that when the market reaches a new high, you should be selling your stocks and buying them when the market again falls. So they try to time the market, which is completely wrong. The world's biggest investors have openly told many times that they are incapable themselves to time the market. Then who are we? So what happens when you sell early? In your portfolio, all the good performing stocks which are giving you good returns, they exit your portfolio and all the bad ones remain. So the portfolio returns go for a complete toss. So what should be your deciding criteria? You should look at the purpose of investment and not the price of the stock. Maximum people look at the price of the stock to decide when you should be selling the stock. And I tell you to completely ignore the price and look at the purpose of your investment. Whenever we are investing any stock, we invest in that company with a purpose. We are not just buying a stock or a share. We are buying a part of the business, and we have a purpose why we choose that business, and why we are trying to partner along with the promoters in that business. So you should look at whether that purpose still exists or not when you are deciding to sell the stock of a company. So when do you say that the purpose is lost? There could be innumerable situations or examples, because your purpose of investing in a stock can be different from the purpose of everybody around you, including me. So we will discuss a few examples of what could be possible situations for loss of purpose. Bad financial performance. If the revenue is continuously declining and you see that the trend looks permanent to you, if the profits are falling down, the margins of the business are squeezing and becoming less, the ratios like return on capital equity are drastically falling down, the debt is continuously increasing and company's liquidity position is going bad, the inventory turnover ratio is falling and the company is not able to sell the goods in time, the accounts receivables are increasing and company is not able to collect the money for the goods they are selling, and the cash flows are turning negative and the profits remain only as book profits and there is no cash inflow. So these are few of the indicators in the financial performance criteria which should ring an alarm in your mind that it may lead, or the situation is coming where you have to consider selling your share. Loss of competitive advantage. When you buy a company's share, the most important thing you look at is whether the company has a competitive advantage or economic moat. So when you see that that competitive advantage is lost, then the purpose of holding that stock gets defeated. Suppose you're investing in a business like IEX. Now imagine after a few years, if the government gives permission to many other companies to set up their own energy exchanges, then your purpose of investing in IEX as a monopoly or a duopoly gets lost. So that day it would be a right time for you to exit the company if this was the only reason for which you had entered the stock. The next could be the competitive advantage related to the intellectual property rights. Let's say in different pharma companies or technology companies, there are intellectual property rights which the companies own. And for a certain number of years, nobody else can produce that product or do that service. So if something like that is existing and which is expiring later on, then that could also be a factor for the removal of a competitive advantage. Suppose there are economies of scale where the company has huge cost advantages when compared to their competitors, and that is lost. Suppose the company's extremely good brand image is completely spoiled due to any incidents. If the product itself gets obsolete, as you know, companies like Nokia did not upgrade themselves into new mobile phones like smartphones, and the companies lost their competitive advantages. Or in the same business field, there are too many competitors, and in future, and the industry itself becomes too crowded. So these could be different scenarios of loss of competitive advantage. Another criteria could be the regulatory changes. If the government takes control of pricing of your products, or the pricing gets too regulated and your margins of that business are going down, like oil and gas companies. If the same business license which you are running is offered to other companies, like CDSL is running a depository and there are too many other depositories coming up in the market with the permission of SEBI, there are stricter and very heavy regulations by the government and the other regulatory bodies, which makes it very difficult for the business to run. If the business model itself is against the government's vision, like today the government is not in favor of companies which are importing things from China and selling in India, either directly trading or using in their manufacturing, as their entire concept is now make in India. So if the company is relying on too much of imports from China due to the present change in the market scenario, then you should be thinking of exiting that company. If the government tries to ban one of the major products of that company, like there is a lot of risk many a times to products like cigarettes. So these could be different regulatory reasons for which the purpose of your investment might be lost. There could be change in sector dynamics. If the sector which you thought was expected to grow very fast for the next few years slows down drastically, and you know that that growth is going to be so less continuously, or it can even degrow for the next few years. If the entire industry becomes obsolete, like nowadays everything is becoming digital and the number of people who are subscribing to physical newspapers is going down. If the sector is affected by a natural calamity like after COVID, travel and tourism, entertainment, hotel industry, all these things are completely affected by the COVID situation. So if something like this happens to the entire sector also, then the purpose of your investment might be lost. Another reason could be the change in the business model by the company. If the company is entering a new business which is totally unrelated to their earlier business, like Excite Batteries started entering into an insurance business, so the lot of investors did not like it because that is not anyway related to the core business. If the change in business model results in loss of competitive advantage, suppose Domino's is famous for quicker delivery and more of a delivery based restaurant, it's not famous for the in dining. So if the business model changes and the Domino's not does not focus on the 30 minutes delivery thing, then the moat can be lost. If the company enters into a relatively lower growth or a low margin business compared to their existing business, suppose the ROE or ROCE at present is 20 and they are investing in a new business where the ROEs, ROCEs are going to be 10%. So that is obvious that the company is going to earn lesser money in the new business. So the purpose of your investment might be lost. The next reason could be the change in the management. Suppose you invest in a company by looking at the leadership and the management of the company, like a lot of people are investing in IDFC First Bank, looking at Mr. Vaidyanathan. So if the management changes, then you lose the trust or you lose the faith in the management of the company, then the purpose might be lost. If there is the business which is heavily dependent on a visionary leader in a company and the visionary leader suddenly expires and there is no succession planning in the company, then the purpose of investment might be lost. The sale of investment from one PE firm to another PE firm, there are a lot of companies where big PE firms hold a major chunk of the management and investment, and they are participating in the management. So when they exit a company and another big PE firm takes over the position, the new PE firm may not manage the company as well as the earlier PE firm. So when you find that sense, then there could be a signal for you to exit because of change in management. If the company's culture is changing, you get to know about the people from the people working there or in the news, then you know that it could be a sign of exit. If the restructuring happens in the organizational structure, suppose another company takes over this company completely, there are two different companies which get merged in the market and you don't like that merger. If the parent company, you have invested in a subsidiary company, if the parent company merges the subsidiary with the parent company, so you get the shares of the parent company in exchange with the subsidiary company's shares. But you invested in a subsidiary which is a smaller company expecting it to grow much faster. Now when it is merged into the parent company, then the parent company, which is already a very big company, may not grow at such fast pace as the small subsidiary company. So these could be situations where the company's restructuring happens and you may have to exit. Another reason from our side as an investor could be if there are too many stocks in our portfolio and we are not able to monitor them, then we should exit and reduce the number of stocks in our portfolio. And if there are stocks in our portfolio of companies which are into businesses which we don't understand, which are not within our circle of competence, as Warren Buffett says, then we should not be investing in those companies. We should come out and invest in companies which we understand better. Another situation could be that you invest in a company that has given you very good returns. It has become a very large company now. Now you identify a smaller company which satisfies all the criteria as per your stock selection, and you want to invest in that because you feel that can give better returns when compared to the larger company which has already grown very big. So that could be also a portfolio reshuffling, partially or fully, to get a better opportunity for you to restructure your portfolio. So these could be the reasons of selling a stock. So the final takeaway is, don't sell when your profit is lost. Don't fear when you're losing your profits on your investment. As long as the fundamentals are intact, the purpose of your investment is intact. So don't sell when your profit is lost, but don't hold even one day when the purpose of your investment is lost. So this is my final takeaway from this video. I hope you like the video. I have tried to make it a little interesting and easy to understand. You must be you must have faced some situation or the other in your investment journey. I would love if you share that experience in the comments below for everyone in our YouTube community to read it, and we can share our experiences and ideas in the comments of holding and selling stocks out of our portfolio. So feel free to comment. Thanks for watching this video. I hope you like it. If you want me to make such new videos, then you comment the question in your mind. I'll work on it and make some interesting video on it. You can follow me on different social media channels, subscribe to the channel, hit like button if you like the video. Consider joining my YouTube community where we are sharing on daily basis the market analysis and live stock analysis. Thanks for watching and have a wonderful, wonderful day.